Today I want to discuss APRA and financial system stability. Hi, I'm Martin North, the Principal Analyst at Digital Finance Analytics. On March the 28th, 2007, Ben Bernanke, the then US Federal Reserve Chairman, said the following haunting words when giving evidence on the Hill. He said, "At this juncture, the impact on the broader economy and financial markets of the problems in the subprime market seems likely to be contained. In particular, mortgages to prime borrowers and fixed-rate mortgages to all classes of borrowers continue to perform well with low rates of delinquency." That was just 6 months before the markets crashed and the bank failures started, leading to significant falls in home prices and the event that we now call the global financial crisis. And even today, of course, we're still experiencing the fallout. Now, this week, Wayne Byers, APRA chairman, gave evidence to the House of Representatives Standing Committee on Economics in Canberra. And he said APRA is maintaining a strong focus on the quality of new mortgage lending and measures to reinforce sound lending standards. Although there are differing views as to the level of competition in the housing and lending markets, we observed that the type of competition that was occurring was clearly unhealthy. The steady erosion of lending standards in the face of strong competitive pressures to generate volume and grow market share. As a result, we've taken a range of measures to moderate the volume of new lending with higher risk characteristics, while stronger lending standards are being reintroduced, backed by higher capital requirements for higher risk portfolios. He said, in our view, these interventions are achieving their purpose. The quality of new lending today is higher than it has been for some time. However, there is more to be done to make sure the improvements in policies are truly embedded into ongoing practices. So we will inevitably need to continue to allocate significant resources to this issue in the year ahead, making sure the industry delivers on its commitment to do better in the future. Or, in other words, don't worry, we have things under control. So let's go back now to 2007. Around the same time Ben Bernanke spoke, this segment aired on Irish television. This will all sound horribly familiar.
Well, for some very lucky people out there, the price of property no longer matters. For the rest of us, it matters a great deal. And yet, when we go looking for sound advice about our most valuable asset, we get divided opinion. The experts agree the rise in house prices has slowed, if not stopped. But when they offer predictions about the property market, some tell you soft landing and others say crash landing. Certainly the pessimists are finding their voice, for example, on last night's Future Shock programme on RTE, which pointed to signs of an impending property slump. We'll be hearing both sides of this critical debate in a few minutes, but first, here's Una Smith.
With no more growth in the housing market, the doomsaying about a crash is getting louder.
It could start tomorrow, or it could take another 2 or 3 years before that starts, but it's got to happen sometime.
It is something outside happening could puncture it here, and there would be very little you could do to prevent it.
So what are the reasons given for a likely crash? The lack of affordability has meant a drop in first-time buyers, one of the fundamentals underpinning real value in the market. Whilst in 2001, 63% of new homes were bought by first-time buyers, it's now at 33%. Furthermore, only 1/3 of properties are now being sold at auction, as opposed to 90% in the boom years. Others say this could simply be the start of our soft landing, with buyers holding back, hoping for the reform of stamp duty.
I'm also effectively abolishing stamp duty as we know it by simplifying the code here, by introducing 3 bands, 0, 5 and 9%.
The second predictor of a crash is that rents have not risen with house prices, suggesting that the market is a bubble and not driven by demand. For example, for an interest-only mortgage on a €1 million house, the mortgage is $4,000 a month, but the rent will only be half that. So if investors pull out suddenly, and they make up 40% of our market, a crash is more likely. In contrast, the OECD says a soft landing is the most likely prospect, And the central bank says that house prices are not out of line with market fundamentals. The third predictor of a crash is our economy's over-reliance on construction, which has slowed by 10%. It will accelerate a downturn if jobs go and workers leave. A final predictor of the crash comes from international experience. In roughly 40 cases, the bigger the boom, the more likely the bust. Given that our boom was so dramatic, with prices increasing by 270% in 10 years, our prices could fall between 40 and 60% in 9 years. The most likely trigger is the devaluing dollar, which is affecting our exports and competitiveness and could lead to multinationals pulling out. Against this, other economists say housing demand is still high for the foreseeable future as the economy grows and the population rises.
That was Una Smith reporting. We'll have two economists in the studio with me with very different views. Professor Morgan Kelly from UCD and Jim Power of Friends First. Morgan Kelly, you're on the pessimistic side of this equation. You've written that the value of the Irish housing market could be halved by an approaching slump. That's not a guess, I'm assuming.
No, what happened was late last year I got tired of listening to these various paid cheerleaders for the property sector saying that we're going to have a soft landing. So what I did was I looked at all the different economies around that have had property booms, and all of them, without exception, have had very big property busts immediately afterwards. You can predict the size of the bust from the boom. It's just like a Roadrunner film. Roadrunner goes into thin air, he doesn't have any soft landing, he falls straight down. Typically you lose about 70% of what you've gained in the boom in the subsequent bust. For Ireland, that means a fall of somewhere in the region of 50%.
You talk about the cheerleaders, they call you a doomsayer. They say the nature of the property business is that if you say it long enough, and people like you say there will be this bust, it's going to happen.
It's going to happen whether we say it or not. We've had several years now, the property industry has been talking it up, saying, great, buy houses, there's no risk of a fall. You have people now, they're mortgaging their lives away, their parents' life savings are going into these houses. It's been talked up, and now it's running out of steam, it's going to fall. If you want an example to frighten people, which wasn't mentioned last night, is Arizona. Okay? Arizona had, again, a boom, much bigger than ours, slightly bigger place, about half as large population, huge inward migration, gigantic house building. Up until early last summer, they were building about 8,000 units a month, exactly pretty much what we're building now. Sales started to fall even before interest rates rose. Construction fell from 8,000 at the start of summer down to 3,000 units at the end. You've acres now of what are called the new ghost towns of the West.
Jim Power.
Now forward to 2008, after the Irish government decided to provide a guarantee to the banks, and this interview with Irish banking regulator Patrick Neary.
The important thing is that risks emerge over the lifetime of the loan portfolio. And it is important that there is adequate capital there to absorb those risks. And by any estimate, the Irish banks are so well capitalised compared to any banks anywhere across Europe that I am confident that they can absorb any loans or any impairments that emerge in the ordinary course of business over the foreseeable future.
Let me take you back to a couple of years ago. You were expressing concern, as I say, about these risky loans, about people getting loans 6-7 times their salary. Why didn't you stop it?
I most certainly did take a very decisive action, because at the time, 2 years ago, when I was speaking about that, you must absolutely provide choice to customers. And customers must be able to make decisions, informed decisions, and have these choices open to them. Our job is to assess the risks and to make sure that the system is able to absorb those risks, which I think the measures we introduced back in 2006 did.
So you don't accept that the banks took any risks before this crisis?
It is part of banking that they do take
unnecessary
risks. And it is absolutely part of banking supervision and regulation that banks are able to absorb the effects of those risks. And I believe the Irish banks are adequately, more than adequately capitalised, and they're very resilient.
Okay.
He separated the banking liquidity crisis from the bank's exposure to property via highly leveraged mortgages and the construction sector, claiming there was no issue. With the benefit of hindsight, this all sounds a bit lame now, given, of course, in both Ireland and elsewhere, the property crash followed. So now wind forward again to APRA Chairman Wayne Barr's recent outing in front of the Senate. Listen to his reply, which was made before the recent Royal Commission hearings to the Senate on mortgage fraud, to the question, Has APRA found any evidence of misconduct among the major lenders?
Rhiannon.
Thank you, Chair. In relation to your investigation into mortgage fraud, which APRA has not made public, has APRA found any evidence of illegal misconduct in the mortgage market by the major lenders?
So I wouldn't say what we've done is specifically a review of mortgage fraud. We've looked generally at lending practices across the board and the controls that banks have to make sure they get accurate information from borrowers, etc., and make a reasonable assessment of a borrower's ability to repay. Part of that are controls to make sure borrowers give true and fair information, but that's not the entirety of the exercise. The second part of your question, if I had it right, was have we identified any systemic...
Any evidence of illegal misconduct?
Illegal misconduct, not at this point. There's nothing that's been brought to my attention.
Well, brought to your attention, is it anywhere else within the organisation?
Well, I'm sure if someone had something of that nature in APRA, I'd know about it.
Do you need to take it on notice?
I'm happy to take it on notice.
Okay, thank you. And has APRA already provided this research or findings to the Royal Commission?
I'm not sure that the Royal Commission wants people to know what information we have or have not provided, but I can say that if they asked for it, we would obviously give it. We would give all information that we were asked to give.
Shouldn't you also be proactive in providing the information?
We'll wait and see what the Royal Commission asks. We could give them a whole raft of information, swamp them with things that are not relevant to them. So we are talking with the Royal Commission about the issues that they are interested in. They have approached us for not just for documents, but for discussions on particular issues to improve their understanding, and obviously we're standing ready to help them as and when needed.
Has APRA in the last 5 years ever held back information from the public? I'm referring to information on a bank that APRA has identified as breaching mortgage lending laws.
I don't think so, but I'll take that on notice. I do have to say, though, we have quite strict secrecy provisions that prohibit us from talking about information relating to individual institutions in the public. But if there was something that was a breach of the law, a clear breach of the law, then those issues would be, at the very least, handed over to other regulatory authorities.
So essentially his answer was no. Now, following close questioning about revelations of lax lending standards from the Royal Commission in the more recent Standing Committee on Economics, Wayne Byers said that while there was a small cohort of borrowers who would have difficulty servicing loans when rates moved higher, there was no sign of a broader problem. He said, "We are still dealing with an environment in which arrears are not particularly high. They are higher than they have been for a while. But if lending was a free-for-all in the way that some are suggesting, I think arrears rates and other things, indicators of financial stress, would be much higher than they are now." That sounds somewhat Bernanke-esque to me. In addition, he said that APRA was not responsible for policing much of the conduct at the centre of the Royal Commission and effectively as a flick past to ASIC. He said these laws are administered by ASIC. Instances of fraud will be pursued by the corporate regulator and the police in some cases. He said, "That's not to say we don't have an interest in these issues, because we do. The prudential interest in these issues is trying to understand the extent to which these issues indicate a failing in the government oversight and accountability within organisations." He said, "We have been calling out poor residential lending standards for some time and the need for those to be lifted." But now, compare all that with the evidence from the Royal Commission over the previous fortnight, where fraud was well among the collection of significant issues explored. During the hearings, we heard about the cases of fraud and bribery, failure to verify customer income, failure to assess customer expenses, failure of internal controls, and failure to report misconduct to ASIC. And in fact, none of the major lenders who appeared escaped scot-free. So, I simply ask, did APRA really not know about the fraud, which is clearly in the system? If they did, then that reply to Parliament looks dodgy. But worse, if they really did not have evidence of fraud, then we have to ask, should they have? To which I think the answer is yes. After all, despite blaming ASIC, APRA is the regulator and this is impacting financial stability. Either way, this looks really shoddy. Oh, and one other matter, buyers addressed the subject of deposit bail-in. Referring to the passage of the recent financial sector legislative amendment, open brackets, Crisis Resolution Powers and Other Measures, close bracket, Bill 2017, he said, concerns have been expressed to some quarters that the bill might allow APRA to confiscate or otherwise use depositors' money to save a failing bank. I would therefore like to use this opportunity to state clearly that this is most definitely not the case. There is no such power in the bill. Indeed, APRA's purpose under the Banking Act is to protect depositors, and the idea of bailing in deposits would be an anathema to that core purpose. So, does that put the bail-in question to bed? Well, yes and no. The problem is there is a difference between depositors and deposits. Looking again at the New Zealand situation, and refer to our earlier blog on this if you want more details, see the link below, the distinction is you actually may save depositors from a banking collapse by using some of their deposits to prevent a bank failure. And buyers talked about protecting depositors, so I'm not sure if this is a how many angels on the head of a pin argument, or whether there really is a real and important difference between deposits and depositors. I guess time will tell. But it is clear to me we need to turn the spotlight on the regulatory structure in Australia because there are gaps between APRA, ASIC, RBA and ACCC, as the Productivity Commission recently called out. The element which concerns me the most is that no one seems to be from an end-to-end perspective across the credit boom. APRA is a regulator of private bank prudential performance, but not a regulator of private bank credit creation, which, as we have shown in a recent post, can be created by the banks from pretty much thin air. Indeed, the RBA seems to welcome credit-fueled consumption, and the Treasury is banking on ongoing credit expansion to drive GDP growth, and through further expansion of the construction sector, and of course, creating more debt. Which takes me right back to the TV programme from Ireland that we looked at earlier. We seem to be walking into a similar crisis, and no one in authority is stepping up to take the steps we need to avoid the crunch, which, on my reckoning, will likely hit now in 2019. This is a major public policy failure. Lessons from Ireland and elsewhere appear not to have been learnt. If you found this useful, please do like the post and add a comment or a question. I do read them all. And if you've already subscribed, thank you. I'm really grateful for your support. And if you have yet to subscribe, please do so now to receive future alerts. I'm Martin North, Principal at Digital Finance Analytics. Many thanks for taking the time to watch.